I'm Owen Bigland. This is the Inside Edge video blog. I want to do a blog here on a couple of interesting comments I had on my YouTube channel here, on the blog that I did a couple weeks ago called Far Beyond Driven. And I had a guy, he's commented before. He comes up with some pretty good comments, this guy. From what I can read between the lines with him, I think he's pretty well educated guy. Obviously owns quite a bit of Vancouver real estate. He's a savvy guy. He understands that timing markets is a waste of time. Just buy and hold good quality assets. So our interests are aligned for sure. But there was a conversation going on about how young people are they're struggling. They're having a hard time saving for retirement. They're having a hard time buying their first property. They're on a renter's treadmill. He kind of said something that I thought was something that reoccurring theme that I've seen, and I wanted to do a blog on it. And he had said, a lot of the young people, or a lot of millennials, or people even in their 30s and 40s, not only are they risk averse, and there's nothing wrong with being risk averse. I would classify myself as being risk averse. I don't take a lot of chances with my money. I've talked about it in my book. I only want surefire ways to make money. I go the guaranteed, slow, methodical way. So for me, that's buying good quality, dividend-paying stocks. So Apple and Johnson & Johnson and Visa and Home Depot and the Canadian banks and Bell Canada, and then holding them for long periods of time, and then buying good quality Vancouver real estate. Buying a detached house with rental suites, or buying a good concrete one-bedroom condo and putting tenants in it for long periods of time. I can tell you, if you do that, keep it for 20 or 25 years, you can't help but make fistloads of money. What the price will do in the short term, though, of course, all bets are off. That's why I always tell people to keep an 8 to 10 year holding period. That will solve all your problems. That will guarantee you make fistloads of money. Same thing in the stock market. You hold these stocks, these good quality stocks. The nice thing is too, you're going to be collecting some cash flows, some dividends and some rent checks. That's even better. Getting paid to hold these assets. You can't help but make money on these things. They are guaranteed, and that's what I invest in. So I'm risk averse as well. You don't see me buying Bitcoin or investing in marijuana stocks. I buy the sure guaranteed way to wealth, which is buying good quality S&P 500 dividend payers and good quality real estate and just holding them. Guaranteed. But he made an interesting point here, and I've heard a few people mention this, and it's something I pick up on, in meeting people and discussing people and having client meetings and things like that. They are so afraid of pulling the trigger on an asset, whether that's real estate or stock. Their biggest fear that keeps them up at night and keeps them out of these markets is they're going to lose money on them. And yeah, you can very easily lose money, but you have to remember something. It's in the short term. So let me go back. I've done a few blogs on this in the past. I've been in Vancouver real estate for 30 going on 34 years now. I have bought a lot of real estate, as a lot of you guys know. I've bought everything: detached homes, townhomes, and condos. I did a blog many years ago saying that I did a review, took 3 or 4 hours, went through my file folder, which I keep pretty detailed records and spreadsheets on my properties. I took a look at all the properties I've ever bought, and 50% of those properties, and I'm a realtor with pretty experienced realtor, inside knowledge, I've got access to all the data, Paragon, everything else. 50% of the properties I've owned, almost 50%, have been worth less than what I paid for them at some time. Now, usually that's within the first year or 2 or 3. I think the longest I've ever gone where I've been underwater on a property was about 5.5 years. That's the longest. After that point, I was break even, and it never looked back from there. The other half of the properties I've bought over the years, I've never been down on. I got lucky. I bought them. They continued to go up. There was dips along the way, but never enough to take it back underwater. I always had a capital gain on them. But if you want any type of success in life, if you want to be able to get your money to work for you, you want to retire comfortably, you want to start living off passive income flows. And to do that, you're going to have to invest either in equities or real estate there's a very good chance that at some point it's going to be worth less than what you paid for it. The good thing is that if you buy the right assets and give it enough time, you'll rise above that. But this guy pointed out, and I agree with him, this is something that people just can't get through their head. And it's why in my book, the first couple of chapters, I talk about the mental mindset, that investor mindset versus the speculator mindset. You have to get comfortable. You have to get comfortable with temporary losses in order to make the fantastic gains over time. That's just the way how the market works. You can't expect to buy something and goes up indefinitely from day one. Sometimes that happens. I've got many stocks that I've owned that have never looked back. I've bought them and they've been on a slow and steady rise, always again dips along the way. They never go up in a straight line, but maybe you buy a stock, it goes up 20% in the first 2 years, then maybe it takes a 5% dip. Maybe I'll buy some more at that time, and you continue to go. But again, just so people understand, here I am, a realtor with 33 years experience. I'm buying the good stuff. I'm only adding the prime properties to my portfolio and doing my due diligence, just like I do for all the investor clients or principal resident buyers I represent. I treat them all like it's my own property, and my clients can verify that for me. Their money is my money. But I'm the first one to tell them that we could buy that West End condo today for $650K, and a year from now it's only worth $620. Or 2 years from now it's worth $610. That's the way real estate goes. But what I've always said, 8 to 10 year holding period minimum. Time will solve all your problems. But young people especially, you have to get comfortable with that. You need to be comfortable with that. In a perfect world, it would be wonderful if you just bought a condo or bought a stock or whatever and it did nothing but go up, but that's not the way it works. There's a kind of a cool quote from a guy that I follow. Kind of plays into this. He's a personal trainer in Los Angeles, real cool guy, very smart. He had a quote that kind of caught my attention. He says, "Everyone wants to rise from the ashes like a phoenix, but few are willing to set themselves on fire." It's pretty powerful. That's a good saying. And that's so true. Everyone wants the riches. They want to retire comfortably. They want to drive a Porsche. They want to have multiple properties, multiple income streams. But to do that, you've got to be able to suffer some short-term losses. But remember, these losses are not realized. They're only on paper. That's the whole thing with this. They don't mean anything. Let me give you a couple of examples. If you've read my book, the first chapter, I set the table with what happened back in 2008 and 2009 with my stock portfolio. So if you haven't read my book, I talk about how my portfolio, just like everybody who was invested in the S&P 500, the US equities, Canadian equities, my portfolio was almost cut in half. Almost. I think it was around 45% I lost over the course of about 18 months. It was like getting stabbed in the gut with a pair of scissors for the 6 months or so. Just continuing down. Huge losses. I had some stocks that were down over 50, 60%. Some were less hit, maybe down 25 or 30. Just to let this sink in, I've got a pretty good sized portfolio and it's going to take you a while to get to where I'm at, but I, on paper, had over $1 million loss there. $1 million. It was over $1 million. Now, did I cry myself to sleep every night? Was I panicking and unloading what I could get from my stocks? Not at all. As a matter of fact, I was buying as much as I could during late 2008, 2009. I'm always pretty much fully invested, as I've talked about before. I keep always a little bit of money on the sideline, and I've always got dividends coming in every week. So I'm always getting new dry powder to put to work. I wish I had more. But I used whatever money was coming in at that time to top up some of the shares on the companies I own at, fire sale prices. But I did not sell a share. And if you read my book, you'll know that gradually the markets kind of turned, sentiment turned, and slowly, like a phoenix rising from the ashes, my portfolio started to go up again. After about 3 years, I got back to where I was again. And as we all know, the market's been on a tear for another 7 years after that. So we're on a 10-year bull run here. So I made back that and a whole lot more. Now, a lot of people sold in that 2008, 2009 crash. Sold it. They bought high and sold low. When the real opposite is, buy low and sell high. But I never sell. I was buying throughout it. But the market recovered and I got all the money back. Let me give you another more recent example, because you have to get comfortable with this. The S&P 500, the stock market, US or Canadian, generally gets a 10% correction or more about every 18 months. Every 18 months. These are very frequent. Sometimes you can get several in the course of a year. They are normal. You have to get comfortable with that. So let's go back to winter 2018, last Christmas. I was in Maui, like I always do. I was out in Maui having fun, relaxing, surfing. I was in Waikiki as well, over in Bonsai Pipeline, having a great time. But during the 10 days I was there prior to Christmas, over the Christmas holidays, we had a pretty sharp correction. Some of my stocks, my holdings were down over 10%, 10, 15%. Some were less damaged. But just to put it in perspective, my portfolio was down about $250,000. Now, I know a lot of people would be aghast by that. They wouldn't be able to sleep. I didn't care. As a matter of fact, I did the same thing. I managed to pick up some more shares of Apple. I used whatever cash I had and did some more buying to top up the holdings I had. But you have to get comfortable with this. It's par for the course. And of course, 2 months later, that $250,000 loss was all made back, and I've made back probably another 100 or 200 on top of that. As I speak right now, last week, we just had about a 5% correction in the S&P 500 and the TSX. These things happen frequently. 10% corrections are quite normal. One a year, one every 10, 12 months for sure, of 10, 15%. You got to get used to it. It's par for the course. It's all part of the overall plan if you want to achieve financial success. It doesn't go up in a straight line. You have to get comfortable with this. And if you can't, you're not going to be able to achieve much in the way of financial freedom, retirement, have any type of retirement, because you're going to be stuck with you just investing in fixed equity. Term deposits, GICs, and savings accounts. Well, those are paying you 1.5% or 1.75%. Inflation's running at 3%, and it's taxed at your full marginal tax rate. The fixed income interest rate bearing accounts are horrible. So you're losing money. You're guaranteed to lose money in those type of products. When you're earning 1.75%, you're taxed on it at 30%. And inflation's running at 3%. So every year you're probably losing 1.5% on something like that. If you want to get your money working for you, you've got to put it into real estate or equities that are going to pay you to hold them, and you're going to get some capital gain. You're not going to get capital gain guaranteed every year. There's going to be good years and bad years. But I can tell you, you keep that portfolio, keep it in there for 20 or 30 years, like Warner, the late Jack Bogle says, you're going to need a respirator when you open up your portfolio in 30 years, and what that amount's going to be if you just stay the course and keep it. You got to get comfortable with that, though. That's why in the first couple of chapters of my book, I set the table with the mindset. You have to get comfortable with temporarily losing some money. But remember, it's not a realized loss. It's only on paper. It's only realized if you panic and sell it. And you should be doing the reverse. When you get these gifts, they're gifts, they really are. We get them frequently in the stock market. 6-7 times a year where we'll get 5-6-7% pullbacks. Any dry powder I've got, I put it to work. I'm pretty much 100% invested at all time. I don't try and time the market. I'm not smart enough, and you're not either. I get these people that will comment and saying, stock market's due for a big crash, and I'm going to cash, or I'm going to gold, or whatever else. They'll tout some of these so-called experts that are, predicting these crashes. Well, I can tell you most of these guys are probably pretty much fully invested. Sure, they're hedging some of it or building up a little bit of cash, but they've still got the majority of their portfolio, I can tell you, invested. But these are professional money managers. Most of them can't beat the index, so why are you even going to bother? Just stay the course, but you've got to get comfortable with short-term losses. That's the way the market goes. But over the long term, it's going to go up. And you have to get that set, because if you can't, again, it's going to be very difficult for you. You got to be comfortable with buying, pulling the trigger, and knowing full well that in 2 years or 3 years, maybe it's worth less or the same of what I paid for it. Don't worry about it. You got a long-term need. If you're in your 20s or 30s or 40s, you're going to be investing your money for retirement for another 30 or 40 years. If you're buying a principal residence, you're going to need that home, as I've always said, until they take you to the old folks' home. So that's lots of time to ride out any short-term volatility. Take advantage of the principal resident exemption and everything else. I'm Owen Bigland. As always, I'll see you next week.